Hi, everyone. Welcome to our educational series, Funding Fundamentals. I'm Teresa Moon, Director of Business Development for Parabilis, and I will be your host/moderator for this program today. The intention with this series is to take complex and intimidating topics and break them down with the experts in the field. If you want to be a successful business owner, you have to be more than a functional operator. You also have to be able to see how your internal and external resources assist your business and assist the success within this industry. Today, we are really fortunate to have two experts that are going to do just that for us. So without further ado, I'm going to allow them both to introduce themselves. We'll go ahead and start with Hugh McClelland, if you don't mind.
Sure. Hugh McClelland. I'm Director of Client Advisory Services at Parabilis, and I also kind of lead our diligence side. So I'm seeing all the problems up front. I'm a background as a CPA. I had then worked in direct investing for about the last 15 years in different for a family office, and then some for some private lending. And I've also done transaction and advisory services in the GovCon space. So kind of jumped all over the finance side and I have a holistic view of it from both the kind of capital side and the investing side. So excited to be on and help the team here.
Thanks, Hugh. And now we have Tom Shemanski.
Hey, good morning. Tom Shemanski. I'm with Rehmann, a professional advisory CPA firm. I lead our manufacturing industry group as long as our CFO services team. My background is primarily in manufacturing. I'm a cost accountant by trade, went up traditional route of corporate controller, CFO, and now I focus on primarily fractional CFO engagements. I work with companies generally under 100 million in revenue and kind of carve out those CFO type skill sets. And business finances is really an area I work a lot with, sourcing and finding and helping companies place the right type of debt to support their growth.
I thank you both for being with us today, specifically to Tom and your team at Rehmann for being not only great partners to us, but great partners to the federal marketplace in general. You guys do a great job. And so being able to line our brands together for this purpose is really exciting for us. So thank you very much for being here and to your team for helping us put this program together. I think what is most important to address in the onset of getting ready with this discussion is that it tends to sometimes be taboo subjects that we're most intimidated by, that discourage business owners from interacting with one another so that they can really find the answers that they're looking for to really impactful subjects. And so the purpose of this webinar is to uncover some of the pitfalls that business owners run up against within these two topics and really uncover the underlying predominant needs of government contractors, which we see in our day-to-day activities being access to capital and that deep dive accounting financial advisory that has to be done from day one. And you guys are both in the trenches with this every single day, leading teams that are assisting government contractors with these needs. And so we've got some questions that are lined up to really address your expertise with regard to both of these topics, and then allow you at the end, all of you who are joining us will have the opportunity to ask questions of our panelists, based off of your respective needs towards their expertise. So we'll go ahead and kick it off. Our first question, Hugh, if you don't mind going first with this one. Cash infusions to a business are the number one need of all businesses, of all sizes, of all industries. So what do you see are the challenges businesses are facing when obtaining financing? And then how do you and your team at Parabilis assist with this?
Sure. So small businesses, in a lot of cases, particularly in a tightening lending environment, small businesses can lack the kind of operational and financial maturity that you might need to get institutional grade financing. Banks might want to see 2-3 years of track record of profitability. A lot of times, small businesses might not have that. Banks are going to want to see pro formas and forecast. That is a challenge that we see across many of our businesses, that kind of 18 to 24 month outlook on the business and being able to forecast and understand where things are going and forecast when cash is needed. Additionally, banks are largely more restrictive in terms of covenants and less forgiving. And so businesses that might see, changing profitability or changing debt service coverage ratios can end up getting sideways with banks if they're not, one, forecasting well, and two, making sure they're not signing up for covenants they can't deliver to. So kind of a mix of different restrictions that we see that businesses don't necessarily know about, that you need to have that 2 to 3 year track record, and that 2 to 3 year look forward to really understand where business is coming and to best use the financing. So.
And Tom, I think that's a great cue to how you guys assist before they go out after that funding. If you wouldn't mind responding a bit to what Hugh said.
Sure. I think what I see in the marketplace is businesses really struggle with bandwidth. They just don't have the resources, the skill set, or the time with their internal financial teams to generate what you need for a lending request, right? And building out that data room of not only historical information, entity structure information, but also that forward-looking forecast, that is really diving into what this PO means to the business, how that pro formas, like if this PO was here 2 years ago, what would the business look like? And how does that cash flow going forward to satisfy any covenants or debt service needs that the new financing structure may be putting in place? So I think that's a lot of times where we'll come in and we'll put a nice team in place that will blend the right level of skill set across analytics, strategic, and then fundamental financing to make sure that, is this a structure we can sustain? Is this a structure that makes sense for this type of contract? And then how do we layer that into some sort of pro formas that tells the story financially on what the business owner generally does a great job is telling the operational story and the business story. And we help fill in the financial story and sort of help them articulate that to give the lender confidence that this is the right type of loan.
I think you did, both of you, a great job of outlining here what the basis of this whole conversation is, why we're having this discussion. I think all too often the single point of failure in the beginning stages of a business is that the business operator is trying to do too much on their own and not outsourcing enough on the onset with teams like yours, Tom, at Rehmann, leading into the process of obtaining that access to the capital that they need to grow. And so I think this was a great lead-off question. And I think going into the next one will assist for those of the attendees that are listening and their heads are spinning a little bit. They don't really know what we're talking about at this level. It's probably a good idea for you to reach out to Tom and his team afterwards, because everything that he's telling you today is going to set you up for whether or not you're going to get the funding that you need when you need it, to really help mobilize on some of these contract awards that you've got that are either in your pipeline or you've actively already won. And so let's talk about it from the standpoint of challenges and obstacles businesses face. Tom, we're going to have you lead us off on this one. What are some of the most common misconceptions that business owners that might be joining us today are having? And how do you see these, pitfalls or these challenges? How do you see that affecting their ability to grow?
Sure. I think there's a couple areas that I generally see. The first is the lack of understanding of working capital. I think a lot of folks will look at, well, it's a $2 million contract. I need to fund 50% of that into materials, and I need to fund it over a period of time. And that at a high level, just describes the contractual need. But then when you talk about, the labor that you need to bring in advance of the contract, maybe the work area you need to prepare to get ready for the contract. Maybe when you got to consider the delay of payment in relationship to when you need to pay your raw material and some of those timing differences. So I think the total cost of working capital sometimes is underestimated. And so then that really puts a lot of stress on the business as you're waiting for that final payment, let's say on a contract, and you've been waiting 30 days and 60 days, and it really puts the business under a lot of stress. And then also, I think it's also modeling out different volume and contract configuration outcomes. I think sometimes people are like, they just assume that, hey, period of performance is this time period. It's going to be released here. I need to get things going 60 days in front of that. But then a delay happens and 60 days turns into 120 days. And they haven't modeled out enough scenarios of possible outcomes to know whether they have enough cash cushion built into their plan to handle, a couple significant bumps along the way.
I mean, I'm with you 100% on this, and I've seen Hugh in agreement, nodding in agreement. Hugh, what do you think? Based off of this as well, I'm sure you've got some agreement there with Tom, but what do you see as some of the most common challenges that are affecting growth?
Yeah, very much so. And echoing a lot of what Tom covered, pretty much nailed it. But, we see a lot of times that, sticker shock of, hey, we have this, $2 million contract. I just need to hire 40 people and that'll just work. And timing delays inevitably happen. Staffing, it is inevitably harder to find than people forecast at the beginning. And then you get to these cash gaps, like Tom's referring to where people don't necessarily understand, and business owners have to have the foresight and forecasting to say, oh, I do need to buy these raw materials now or hire these people now, and I won't get paid for them for 6 months, 9 months, whichever the delivery order. So lining up that cash timing and understanding working capital is critical, and understanding that some things like staffing are probably more difficult and take longer, particularly in certain periods of the year where it's slower, and understanding that you're not going to have 100%, you're not going to fill 100% of your seats immediately. A lot of the time, it might take 3, 6, 9 months. So having that foresight to get ahead and see where problems can be, and like Tom said, have a contingency plan of, hey, I'll need funding to float us through here, and communicating that to your lenders and understanding that when you'll need cash to why.
What I'm hearing, oh, I'm sorry, go ahead, Tom.
No, I just one follow-up. And when you really talk about what impact does that have on growth, maybe one contract doesn't have an impact, but the performance you do on that contract does. So what does that customer view you as if you have a misstep? What does your own internal team think, if you have a misstep, right? Those type of things impact your internal team and external customers, because if they lose confidence in your ability to manage a product and project or fund a project, they're going to be a lot more conservative, which will directly impact your ability to grow.
Great ad there. I mean, I was going to highlight the fact that you both made mention to having that strategy in place, that planning in place. I think government contractors are, engaged at the past performance level because they see that as the bread and butter of what gets them that next contract or that growth down the line with those awards that they're going after. But it's that financial record keeping, that financial past performance that they sometimes overlook. And not because they don't see it as being of top of line item of importance. I think it's just their lack of understanding of that process and not putting the right partners in place to help them with the levels of their business that they might not be the expert at. And so it's equally as important to have a business plan in place and charting the strategy of how to reach those milestones along the way. But so much so having that financial strategy in place as well of how are you going to achieve those milestones with the cash flow that you're going to have access to along the way. So really making sure that the external resources that you're utilizing know all about that as well, because it's one thing to reconcile what's already happened, but it's another to look forward and take what's in your pipeline and helping you strategize based off of your pricing strategy and your ability to actually win what you're going after, right? And making sure that once you win it, you're going to be able to fund it. And I know that some of our questions that we're going to get to are going to address that a little bit more, but wanted to make a point. Those of you who are taking notes right now, those were really great core questions for our discussion today. So awesome. I appreciate those responses. Hugh, let's go back to you and talk about, from your perspective, when businesses are going and seeking additional financing or financing in general, right? Financial advisory support, because Parabilis provides both. What's your recommendation on relationship attributes of cultural fit, timing expectations, things that we look at internally at Parabilis? What's your recommendation there?
Sure. So, one thing I really like about Parabilis, and I think sets us apart, is it's not a counterparty relationship like it would be with a lot of banks. So where, you want a financial partner that is truly that, a financial partner. And I don't say that cynically. Having a lender that understands you personally as a business entrepreneur and owner, and your business, which, we have the advantage of, a lot of banks might not necessarily understand government contracting at the level of granularity. So having a partner that understands government contracting, can identify these problems and know there's delays and it has worked with the government is incredibly helpful. But just having a lender that and financial partner that you feel honest with, that and that you know, if you have a problem and it's, you know, something that's critical to your business, having a lender to where you can go to that lender, explain the issue, and they'll help you out with it. And as opposed to, you know, I've seen it versus my time here versus the past, to where, you know, I'll have CEOs call and ask very personal questions and be very honest about the state of their business, and helping them work through that is really a fantastic, having that relationship where you trust your lender, that they'll work with you, that they'll understand your problems and won't just snap a covenant on you. I think that level of empathy is really important. So one, having, you know, we like to roll our hands up and kind of get in our businesses and help with the pro formas and the like. So having a lender that you're willing to open that up for is incredibly important. And timing wise, you know, like we said, you can win a contract and need to fund in the next week. Well, we like to be agile and be responsive to their where, you know, you want a lender that can grow alongside you is what I would say. So.
Awesome. Thank you. How about you, Tom, on the financial advisory side? What do you see as recommendations for those three?
Yeah, I think, you know, if your advisor doesn't feel like they're part of the team, then it's probably not the right fit, right? So you want someone who's going to come in, get to know your business, and throw their hat in the ring with you, right, as a partner, to work side by side, you know, actively collaborating with you, you know, not just, you know, getting data and then writing an email and saying, here's what I think you should do. So I think that's one attribute that I found that a lot of clients value. And I think too, you're looking for someone who's going to match the right skill set. So it's important that you understand their past history, their experience, and that there's a team. You know, at Rehmann we use a team approach. You know, in a lot of projects, yes, I'm the CFO consultant and working at those high level. But if I need someone to build out a financial model, you know, I've got someone on my team that's really good at that skill set and whose fingers work a lot faster than mine on a keyboard, that will efficiently put something together, you know, and provide help build that data up. So I think those are some of the attributes. You know, you're looking for strong communication skills, strong project management skills in that relationship. And then I think you have to have also realistic expectations on timing. If you're ready to, you know, if you know there's big stuff coming, you know, be looking now, because I would say it typically it's 45 to 90 days to get someone integrated into your team, to understand your business. You know, I tell all my clients, like, you're the expert at your business. I'm going to come in and bring some best practices, some good tools, and some practical, you know, work experience to help sort of guide us through this process. But there is a learning curve, right? Don't, you know, someone who can come in and say, "Oh yeah, I'll have everything I need for Hugh in 7 days, and I know your business, and you know we'll get this done." You know, that's probably going to be a challenge, right? So it is getting someone in to get them up to speed quick enough to help support a financing effort. It just doesn't happen overnight.
Right. And I think something that I've heard from both of you is that that collective team approach. It's so important in building trust in relationships like these, having access to the person who's standing up next to you on this. And so as a business owner, you're the best representation of your capabilities, but then having external partners that can stand next to you and meet you there with the capabilities of the business and then share their expertise to further the momentum of your success is super important, but it doesn't happen overnight. And so really understanding that, picking the right partners that not only understand your industry, but have the time to allocate toward what the ultimate goal is for the relationship is very important. And I think it's something that Parabilis and Rehmann collectively do very well, is building teams around the clients that they service and having it be a human to human interaction. It's not a transactional relationship where we're just sending emails or putting in borrowing requests or, you know, asking for people to build reports. It's really understanding and advocating for them as if they were a member of the actual team itself. And so I think that's something to be commended on both sides, that your teams do very well. So that's great.
Yeah, we
Let's
assign basically a full team to each client that sticks with you for your whole relationship. They're talking on the phone day to day. They know your business better than you do in some cases because they're seeing the kind of detail, and it's really neat to see the relationships that our clients build with even our staff that they're dealing with on a day-to-day basis, because it's there's an empathy there, and it is a team approach. So just echoing that we try to do the same.
Absolutely. I think it's just that investment that you make in those human relationships that really build the trust, and that's amazing. And you guys both lead teams that perform on that level, so that's awesome. Tom, this one's for you. If you wouldn't mind talking about the importance that financial reporting is to the business itself, how important it is to maintain accurate forecasts and cash flow projections, which you've talked a little bit about. I'd like you to get a little bit more in depth. And then we'll get into a little bit about how this is important to the business's ability to, access increasing amounts of capital. But on the onset, Tom, what do you see about the forecasting and the cash flow projections and the impact that has?
Well, it has a huge impact with lending relationships because it highlights those companies that are forecasting and doing cash projections. They're demonstrating the ability to be proactive and to look forward, versus looking backwards. Everyone can look backwards, right? Everyone knows where they've been. I've had way too many clients over the years, come to me 2/3 of the way through a project and say, boy, I can't fund the last third of this project. I've got payments due to vendors that, they have 30-day terms. I'm not getting paid for another 4 months. And, I'm gonna be in trouble with this last third of the project because they want final payments to release their component into my, product. And now I'm in a bit of a bind. And, it just demonstrates like they just didn't have a good enough forecast up front, right? They didn't work through enough scenarios to have enough cushion to comfortably manage that situation. So I think that ability to be proactive, to be forward looking, you have to have rolling forecasts, rolling financial models that are always looking at your business and analyzing the what if scenarios. And so I think that is where businesses don't spend nearly enough time from a strategy standpoint. Part of it is they don't have the right tools. They don't have the right models, the right technology, the right data collection to feed into these type of systems. So we do a lot of work in that area, sort of figuring out where the data is, how do we pull it in, how do we validate it. But I think that is probably because I think what that does is it helps you identify key milestones in danger zones, right? We know that, hey, if I don't get this milestone done, that delays a progressive payment potentially on a project, and that's going to put me in a bind, right? Because I got a lot of money I got to put down to get put as down payments to get started. So those are some of the attributes that can help you, use financial models and forecasts to help you manage those milestones and quickly identify when you're approaching a danger zone, when you got to put your hand up and say, hey, customer, hey, vendor, I need some help. Something's gone sideways. We got to get this fixed, right? Or your lender, you got your stakeholders, you got to communicate early to.
Mm-hmm. We see that often in our scenario as well. And so, Hugh, if you wouldn't mind speaking to how this is important to the business's ability to not only access the increasing amount of capital that they might need to fund their growth, but from a strategy perspective as well, because we tend to consult with the business owners that we work with at Parabilis about that as well, if you wouldn't mind elaborating there.
No, certainly. And Tom made some excellent points there, and I'll piggyback that having these accurate and having this culture of planning and a forecast going forward, we see it in our business. We're managing capital and we want to do so efficiently, and we want to do so we don't get in a bind when someone comes up and, hey, I need $500,000 tomorrow. We see that sometimes with our clients. So having that. We spend a lot of time, for instance, clients that are doing delivery orders or longer term projects, making sure we're tracking those milestones alongside them just so we can have an idea of when they might need capital and how best to use our facility. So that's incredibly important, particularly on some of these clients that we're seeing that these are maybe you're a manufacturer. There's a lot of parts and pieces that have to come in and be assembled at the perfect timing, and making sure you're forecasting that and know that I have to hire 4 people to do this, or I have to allocate resources differently. So being ahead of that and that planning allows us to be proactive on your side. So when you talk about obtaining increasing financing, well, the longer you give us to kind of plan alongside you, we can make sure that we structure that to best fit you, because there's inefficient ways to use capital too. If you're drawing cash you don't need and paying interest on it, that's not efficient either. So knowing, again, it comes back to that working capital, but knowing, we ask our clients, 30, 60, 90 days to just have a running idea of what's coming, what contracts are coming on, what are coming off, so that, you're able to kind of maintain your ability to pay expenses and your ability to service the debt. So.
Super important. I mean, all of your points are noted here, and I appreciate that very much. I think, these two aspects right here, this question alone is the core of this discussion. And so I hope everyone was paying close attention, because we're gonna, transition into talking about the economic environment that we find ourselves in now. I think, there's a lot of things that going on, right? We're in an election year, so that impacts a lot of things. We're looking at things on the government side that could be ever changing, from an interest rate level and things of that nature. And so, if we could chat through a little bit about how this economic environment and outlook for small business is affecting your side of this discussion. We'll go ahead and Hugh, if you want to kick it off on that side, what does it look like from your perspective towards our clients, the economic environment that we're in?
Certainly, and you kind of hit the chief issue on the head, is that there's a lot of uncertainty as to how this election will go, and there's obviously two very different directions in terms of the budget that we could take. So one, our ability to have confidence in Congress to pass budgets and to make funds available is kind of in the air right now. So small businesses are dealing with that. There's still kind of these lingering COVID and supply chain issues. We're still seeing that impact businesses even years later now, to where supply chains were constrained and now kind of loosening, but maybe tightening again, and having that ability to kind of make sure you're efficiently sourcing materials and the like. We see that, to where clients might need to be very proactive in thinking, hey, I need to buy commodity X, Y, or Z in this environment before I can't get it in the future. So still seeing some of that. Finding, it's a tight labor market, so finding, as many of the participants know, finding and retaining skilled labor, particularly for some of these specialized positions, is really difficult. I mean, there's a set pool of people that can do a lot of the things we're doing, particularly locally, and at different clearances and different kind of skill sets to fit particular contracts. And that's a very competitive market, to where, a lot of businesses find themselves commoditized, to where employees will just go from, business to business and continually drive up the rates. So finding and retaining talent and labor is incredibly important. Also, there's emerging trends we're seeing in technologies and AI and the like, where, there's just a lot of uncertainty on how that'll impact all of our businesses, and how these will get implemented, and how they might impact labor markets, and maybe you're able to kind of make efficiencies where they weren't before. But there's just a lot of uncertainty. And then also we've seen, the rate environment, to where, Powell's coming out last week and saying he forecasts cuts, but it's not sure until it happens. And so forecasting 3, 6, 9 months ahead of time, will there be more cuts? Will there be raised? Who knows? So that's a challenge for all of us, particularly, small businesses in this sense.
That's great, Hugh. Thank you so much. How about you, Tom? What do you see from your perspective as the outlook for small businesses?
Yeah, I think some of the indicators, we're sort of tracking it. It is very mixed results, and so we have contrasting type movement in certain indicators. The purchasing managers index, at the end of Q2, contracted for the 19th out of 20th straight months, right? And so there's this kind of feeling or sentiment that the manufacturing sector is contracting, right? That there's some pressures going on there. Interest rates remain high, so that cost of capital for new equipment, especially large capital expenditures, there's harder to make those justifications with interest rates at the current rate. But then on the other side, we do have some good news, right? If you look at inflation over the past 6 to 9 months, some of our major inflationary factors have all come down fairly significant off of their kind of really recent highs, post-COVID. So we're starting to see some stabilization in pricing in a lot of areas, and those cost starting to come back in line with some historical averages. And then while we still have a labor shortage problem, the byproduct of some of the mixed results is that the market has stabilized a bit. We're not seeing the significant year-over-year labor increases that we had the prior couple of years. We're also seeing the job availability of qualified candidates starting to improve as well, because I think there's not as many openings. So as there's less openings, the number of candidates for those openings I've started to see improving with a lot of clients. So there, there's some good and some bad, and I think a lot of the election will set the tone of where the next 12 months is going to go from a policy standpoint. Tariffs is one that we're very interested in seeing what goes on with tariffs, and that could impact the amount of outsourcing, insourcing in the U.S. for some industries based upon who wins the election and what our stance with China is, and tariffs could have a big impact on that as well. So those are just kind of some things that are I think weighing on where the direction of the economy is kind of looking to go.
Great. I appreciate both of your perspectives on that, because I think you both make great points. And I want to encourage everyone that's joining us live right now to utilize the chat box to put in any questions you might have for our panelists. We'll go through those as we receive them. So if you wouldn't mind taking the time to do that now, we'll go ahead and queue those up. And we've already had a few that have come through, and we'll go ahead and start with those that we've gotten first. And Tom, this first one was for you with regard to, what does a typical engagement look like with a financial advisory firm to support a business? So when you've got someone that's looking for assistance from your team, what does that typically look like?
Yeah, I'd say they take two typical formats. One is just a project basis where they're looking to bring someone in with the right skill set for a specific issue, right? And so then we'll generally put together a project scope, identify what needs to be done, put together a budgetary hours estimate, and that's kind of a project, right? And business finance falls into that a lot, because someone will say, I need some help finding lenders, supporting the underwriting process, putting some pro formas together. And, that could be as short as a 60-day up to a 6-month, depending on the complexity of the need of the financing. The other option is more on that fractional CFO side, where the business has just identified, like, financing is just one of the pieces I need help with. I'd love help with putting some strategy structure together. I'd love an annual business planning process. I'd love better margin analysis. I'd love a more structured budget process. I'd love to bring someone on in a fractional role. And then those work more on a flat monthly fee basis. So think of it as an annual type cost that, we really layer in right with the team. And we're just almost like part of payroll, where they'll say, oh, we're going to spend, $50,000 a year on a fractional team to come in and help in some of those areas. So as a client, you appreciate the cost certainty. It's a fixed amount. It's a block of time. You know what you're getting, and you know what the focus areas are. But those are the typical structures of an engagement. And then it's a lot. What COVID has changed is the amount of remote versus Zoom type meetings. And that really depends on the client. Like, some clients like to meet in person more so. Some clients are fine with Zoom because they're always traveling. So it's very dynamic, it's flexible, and it really scales to sort of take the right skill set and fit it to the need.
That's great. I appreciate that. We had another question come through. Hugh, this one's for you. What do you see as the most predominant reason businesses seek alternative lending? And how has this changed? I know since I've been Parabilis, it's changed quite a bit in the last 5 years. How has it changed in your tenure with us?
Sure. So, obviously, we like to say we have a self-selecting group of clients, and that it's people that either choose not to work banks, or don't want to work with banks, or cannot work with banks. And so as banks have, tightened lending standards, particularly on, higher rate clients like ours, it becomes very restrictive. And what alternative lending offers is kind of that flexibility, to where you're not necessarily being beholden to, this credit box and covenants, and if you trip it, then everything goes away. We can be more flexible on the private credit side in terms of how we set covenants, how we manage the loan process. We like to say we kind of work through problems instead of work out problems, and that if we have an issue, we're, as a private lender, we can engage directly with the client and not have to kind of work through a bank. And so that kind of agility and flexibility and, ability to underwrite maybe an asset class that might be a little more esoteric, or a contract that might be a little esoteric, is where alternative funding really finds a gap there. And in my career, I've seen it. I've been working in alternative lending and indirect investing for 15 years now, and I've seen that market evolve as banks become more risk averse, and capital is going to come from somewhere, and people are searching yield. We're able to kind of fill that gap as an alternative lender, and again, it's really that agility and that flexibility and our ability to understand government contracting and not just put you in a box and say, okay, you just lend. And it's really that hand-in-hand relationship. So in my experience, that's kind of where the market's gone. There's appetite for alternative lending, both on the capital and investing side, but also from business owners and businesses that might desire that flexibility and that kind of open relationship in terms of being able to work with your lender to restructure when necessary and kind of have that relationship.
Awesome. Thank you. Tom, we had one come through for you in terms of customer and industry diversity. How important is that from your perspective?
Yeah, I mean, it's important in a couple of key areas. One is it's a key factor in risk mitigation. When either lenders or even new customers, evaluate your business and they see that, you've got 60% of your business with one customer on one primary contract, right? That's a huge risk, on financing and and evaluating that risk profile. So bringing in additional contracts to diversify, both within customers, within contract types, within industries, right, just really makes it a more compelling business case from a lender perspective and from even your customer's perspective. That there's a lot of your customers that if they're your biggest customer, they really would love you to have another significant customer to help spread the diversity and the risk out across more than one customer. I think the other thing it does is it really, as a business, it really protects the enterprise value and really stabilizes the business, because if you have a major contract and it goes down 30%, you might not have the overhead flexibility to cut overhead in the relationship that major contract goes down. So I do see a lot of businesses, sometimes their largest customer or largest contract has a significant decrease, and like their fixed cost is their fixed cost to a certain extent. They just can't engineer more out of it. And so there is an enterprise value aspect, and that your business is just worth more the more diversified it is. I mean, that's just a simple reality. So those are a couple things to keep in mind, and why looking to diversify and staying diversified is super important.
I couldn't agree with you more. And I think, from an internal perspective, I'm sure he would agree as well. We promote diversification in contract awards, not putting all of your eggs in one basket with regard to a specific agency or a specific prime, because a lot of that is relationship driven. And if that person changes where they're working, that relationship goes with it, and it might not take you along with it. And so being diverse in where you're going and engaging in terms of supporting missions is equally as important. We've seen on our side a lot of times clients of ours doing a great job supporting the mission of one particular place, and the relationship that helps them keep that momentum going might move on to something else or retire, as we see things happening internally with government right now. And so it's equally as important to diversify there as well. So great point. I've got another one. I also want to say again to encourage everyone, if you've got a question, stick it in the chat box. Otherwise, we're gonna finish up with this one here. This one, Hugh and Tom, I'll let you respond on this as well, because you'll probably have some insight that's different. But we see on our side of it at Parabilis that banking regulations and covenants tend to stifle growth to a certain extent. They definitely affect it, but it can stifle it as well. What do you see the biggest difference between Parabilis and bank funding? Because we get asked that question a lot, and a lot of times people focus on, the cost as opposed to some of the other factors that apply there as well.
Certainly, and thank you, Teresa. And going back to kind of my answers before on, private lending versus banks, we're able to be very, we're not regulated, so we're able to customize covenants and renegotiate covenants for our clients if need be, to where banks would have, we've seen people come from banks and they're surprised that, we're able to be so flexible. So we're able to be patient. And that's really what we hear a lot around here is we're the capital, we can be patient and we want to help the client, not, again, it's work through, not work out or charge off. So we're able to kind of, waive covenants if need be, or customize your covenants to, fit whichever your net income we forecast or EBITDA, different EBITDA levels. That's helpful to be able to have that flexibility. We're constantly, working with clients on the front end and the underwriting and setting up loan structures that fit their pro formas and that, might have interest only or an accordion. And we have that flexibility to where a bank might not necessarily. So we have that level of agility, our ability to work through covenants, to, make risk-based decisions on, what the client needs, and knowing the client well, knowing ahead of time, hey, you might trip this covenant that we have, but having that conversation instead of have it be reactive. And I think that's a big difference at Parabilis and in private credit versus what I've seen elsewhere, is that we're able to be flexible on that. We're able to consider, we're not going to choke the business off because of, a minor trip of a covenant or a regulation. We're able to work around it and work through it. And I think that's been demonstrated in how little charge-offs we've had because we're flexible and agile.
Awesome. Thank you. Tom, any thoughts on that?
Yeah, I just think it's important for businesses to, before they get into a financing project, understand what their business credit profile is and what their contract credit profile is. To keep it really simple, everyone falls into an A, B, C type bucket, right? A being a top credit that's going to get the lowest interest rates because of their credit profile, versus a C, which is going to be the highest, cost of capital because it needs the most flexibility. So those are the things you need to understand going in, where you fall on that spectrum, so that you're talking to the right partners, right, and understanding what those needs are. But I will say, in understanding that your business can absorb the cost of capital, right? Because if it's a non-starter, don't wait. And if a 12% interest rate can't be afforded in the contract, well then don't waste anyone's time pursuing financing for 12%. So I think that's another big thing, is understanding what you can absorb for financing cost into your contract, which means you got to understand how much you need to borrow for how long, what that cost of interest is, and how that gets absorbed into the total contract price. So I think sometimes people don't look at that close enough. They just jump into it. They think they can make it work. But then all of a sudden they start doing the numbers. It's like, this cost of capital, it doesn't, I'm not competitive. I can't get the contract, or I'm going to do it and not make any money or lose money, even worse. So I think those are some important considerations to take when you're looking at, taking on a contract and needing particularly alternative financing. Because I have some clients, it's like, cost is an issue. I can get the cost covered. It's the availability, right? And that's the great benefit of an alternate financing, is the availability, the flexibility, no covenants or limited covenants, quick turnaround. Those things are all great attributes, but there's a cost basis for that type of relationship, the amount of work it takes to manage that type of relationship. So I do think that's an important thing. You need to understand whether your contract can handle that cost of capital. And if it can, you just have to understand that, what that cost is, so that you can benefit from that flexibility.
And that goes back to the forecasting we talked through on this entire call, having that ability to forecast going forward, both, your business and how this facility fits into your business is, like Tom said, it's critical. You don't want to get 6 months down the road and realize that this doesn't have the availability you need, or the interest rate's too high, and then, you're in a cash crunch. So.
Mm-hmm. Well, I certainly appreciate your joint expertise here. We've put on the screen the contact information for both of you, along with the websites for both Parabilis and Rehmann. I super appreciate you both for taking some time with us today to engage with our audience. And going forward, anyone that's joining us both live or watching the recording can reach out to the Parabilis team and the Rehmann team to get that expert insight on everything that we've just discussed today. And so again, thank you, gentlemen, for being here. I appreciate you very much. And I hope everyone has an amazing day.
Thank you.
Thanks.